Hello, everyone. Chris Hobart here, and welcome back to another episode of the Wealthologist Weekly. This week, we've got a jam-packed session as we dive into some of the most important economic reports for August. Now, it's time right now of the month when data begins to hit the fan. And this week in particular, the numbers we could see will tell us about where the economy is heading. So I want you to buckle up because there's a lot of content here. Now, this week, we're getting a slew of crucial economic reports, including things like consumer price inflation, producer prices, retail sales, industrial production, housing starts, and unemployment claims. I got to tell you, that's a lot to unpack. That's why we're here, to let you know what's important and maybe what's not so important. Now, to begin, I want to talk about the broader economy. Right now, it looks like the pace of economic growth is slowing down. Now, this deceleration is happening as the tighter monetary policies, those increasing interest rates that we've seen over the past couple of years, are finally starting to bite. But here's the thing, that slowdown has taken a lot longer than anticipated, and there's a number of reasons why. First, the unusual nature of the COVID lockdowns and the reopening. There was a massive wave of monetary stimulus around that time that came before the tightening. There's also an unusual expansion of the federal budget deficit last year, despite low unemployment. And also, let's not forget the Supreme Court decision on student loans, which temporarily made the deficit look smaller than it really was. We talked about that a couple of weeks ago. Now, in the past couple of weeks, we've seen some telling signs: a decline in construction activity, slower job growth, and mixed signals from the ISM indexes. Manufacturing seems to be contracting while the service sector is hanging in there, but not looking great. So, what's on the docket for this week? Well, it looks like both consumer and producer prices in July rose by about 0.2%. That's a bit of good news, especially when you consider the higher inflation rates we've been wrestling with over the past couple of years. If this trend continues, we might see inflation slow even further later this year. But, and I got to tell you, this is a big but, it doesn't mean that inflation will stay low forever. So don't get too excited. Eventually, the Federal Reserve is likely to ease up on monetary policy again, probably too much, which at that time could send inflation ticking back up. Now, I want to take a look at retail sales and industrial production. Now, we're expecting mixed news here. Retail sales might show an uptick thanks to a rebound in auto sales in July. And you might remember that auto dealers had some tech-related issues back in June, which really hurt sales. Now, if retail sales do grow as we expect by around 0.5%, they'll only be up about 2.5% compared to a year ago. Now, that's not exactly outpacing inflation, but at least it would be keeping up. Now, on the flip side, industrial production is actually likely to dip, and this is led by a slowdown in manufacturing. And while production might still be up slightly from last year, not by much. So does all this mean that we're heading into a recession? Not quite yet, but let's just say the storm clouds, they're definitely gathering. You see, monetary policy is tight, and it has been for a while. Now, at the same time, banks are likely tightening their lending standards, even as the Federal Reserve inches closer to cutting short-term rates. Investors should be cautious. The financial markets might be underestimating the potential for slower economic growth with all of these moving parts. Now, if we take all of this data together, it's starting to feel a bit like what we call stagflation, the kind that we haven't seen since the 1970s. Even with all the advances in AI and space travel and 3D printing, the economy is growing slowly, and inflation is still above the 2% level that many have considered the benchmark for price stability. Now, COVID lockdowns and the subsequent reopening, they've thrown a wrench into being able to look at things for seasonal adjustments. And those massive federal deficits we've seen have allowed spending to keep going. But here's the thing. That bill, it is coming due. The U.S. economy is in a bit of a tight spot right now, with many calling for more government intervention. So the question that we've got to ask is, how is this all going to end? And that's tough to say. The experimental policies of the Federal Reserve and the Treasury, they're making it more and more difficult than ever to really predict the future, which means we've got to make decisions, game time decisions. Now, you're probably saying, what does all this mean for me? Well, staying informed is more important than ever right now, which is what we're doing here at our firm. That's why we're here. I, I want you to keep an eye on these reports that we put out there and also how they can impact your financial decisions. As always, if you found this video helpful or if you need some additional information, you can reach out to us. But please don't forget to like this video, subscribe, and share it with anyone who might need a little economic clarity in their life. Thanks as always for tuning in, and I'll see you next week on the Weekly Wealthologist.